Consumer spending drives almost 70% of America's economic output. But investors surveyed by Bloomberg now think that this most potent economic force may finally be running out of steam, and that it will show up in company earnings around the beginning of next year. Hello and welcome to Economics.ai. In this video, we'll look at what the consumer spending and savings pattern looks like in America, and if there's any evidence to support the assertion that the American consumer is running out of money. Consumer spending, or personal consumption expenditures, PCE, is goods and services purchased by consumers. Personal consumption expenditures include durable goods like cars, furniture, large appliances, non-durable goods like clothing, food, fuel, services like banking, healthcare, and education. The fear is that as household savings run out, the fortunes of the U.S. economy could reverse. Household savings in the U.S. have fallen steadily and are poised to run dry in the third quarter. Michael Burry, the famous investor from The Big Short, is also sounding the alarm on the possibility of U.S. consumers to run short of money due to historically high inflation plus higher interest rates. Burry says the drying up of consumer savings will soon start hitting corporate profits, as spending declines on all but the essential items. Chris Watling, chief executive of financial advisory firm Longview Economics, told CNBC the same thing. Of course, retail sales have been quite strong for the last few months and everyone gets quite excited about that. But, actually, if you look at what's going on, the household savings ratio has been run down, and, in fact, real income growth has been negative for 3 months, Watling said. TransUnion, a credit reporting company, said that total bank card balances rose 15% from a year ago, to a new record of $995 billion. TransUnion also said that the average balance per consumer was up 11% to $6,088. But what is the data saying? Let's look at the evidence from Economics.ai. Retail sales in District 1, Boston, showed only a modest increase through the end of the third quarter compared to earlier in the year. However, tourism saw mixed results. In District 2, New York, consumer spending sentiment rose steadily from May to September but then dropped significantly. For October, spending on apparel, interior furnishings, home electronics, and appliances grew at a steady clip. But customers have become more price conscious for more expensive items like cars. Consumer spending in District 3, Philadelphia, was affected by higher interest rates which were making customers much more price conscious. District 4, Cleveland, saw consumer spending flat to lower with more lower-income people turning to credit to finance purchases. Retail sales in District 5, Richmond, grew slightly this cycle, but reports varied across spending categories. For example, food service and grocery stores reported steady sales, but more expensive items like furniture, appliance, and home remodeling saw sales declines. District 6, Atlanta, also saw customers cut back on discretionary spending. Consumer spending in District 7, Chicago, increased slightly over the October reporting period. District 8, St. Louis, saw consumer spending take a hit for higher ticket items like autos. Dealers reported that despite pent-up demand from lack of inventory, sales were still affected by unaffordability owing to customers' decreased savings and higher credit card debt. In District 11, Dallas, retail sales declined slightly over the past 6 weeks, again with notable weakness in auto sales. Auto dealers pointed to reduced affordability spurred by higher interest rates as a major factor. District 12, San Francisco, bucked the national trend by reporting robust retail sales in recent weeks. Demand for groceries, particularly health-oriented and fresh products, was strong. And retailers also reported robust demand for furniture and some home improvement products. If we look at the personal savings chart, we see that even though there was a slight bump in Q1 2023, the trend in savings is well below the pre-COVID-19 trend, lending some credence to Michael Burry's analysis. Will the US consumer run out of money and send the economy into a recession? Or are we set for a productivity boost that will see wages rise and allow the good times to continue? Let us know what you think in the comments below.